different this time than in any market I have ever seen related to precious metals is the number of deliveries. We are seeing massive deliveries into COMEX, and to me that is, I don't know, all you really need to see. And I don't mean to be trite in answering that question. I'll start by saying, before I give you the numbers, that the people that are doing this are the most well-funded and, I think more importantly, well-informed traders in the world. And if we, for example, realize that a silver COMEX contract is 5,000 ounces and a gold COMEX contract is 100 ounces, the amount of deliveries that I'm about to explain to you, I think you'll understand that these are numbers that, these are numbers that the people that are doing this, I believe, don't do these things just for the heck of it. And they, I believe, have a good idea where things are actually going. So if we look at the month of December, we start to see a trend that we've seen now for going on 15 straight months since November of last year when Trump won the election. But every single month we're seeing massive deliveries. In the month of December, we saw 3,706,000 troy ounces of gold issued and delivered on COMEX, 3.706 million ounces. And, you're into the billions of dollars. But an all-time record for the month of December, 64,730,000 ounces of silver delivered. They say issued and stopped. That means actually delivered to the COMEX. Some leaves the COMEX, some stays in the eligible category, not for sale. The bottom line is, if we just look at the month of December, what you're seeing is billions and billions and billions and billions of dollars of metal delivered into the COMEX. So we got 64,730,000 ounces of silver in just 6 trading days in the month of January here, which is a non-delivery month. We've already seen pretty darn close to 36 million ounces of silver delivered and several 100,000 ounces of gold delivered in just the first several days. And when you think about this and ask yourself, who the hell's got this kind of money? So far in the month of January, exact numbers, 6,690 contracts delivered, about 33.45 million ounces of silver. And in terms of gold, it was almost 600,000 ounces of gold have been delivered in just the first week of delivery on COMEX. And so for me, what's really different above all else is that, this is a situation where continuously we're seeing the most well-informed traders here in the United States go to great lengths to stand for delivery on precious metals. That's something we never saw before. And the U.S. has become a net importer of gold after being a net exporter of gold for the last 40, 50 years. So, I don't know, I would say that to me is the most different characteristic I've ever seen in this industry, where COMEX has been more than anything a vehicle for speculation and exports. Now all of a sudden we're seeing deliveries that are so far outside the realm of what is normal that it's impossible to ignore. And what bothers me more than anything is the lack of mainstream coverage by this, because this should be mainstream news. Who's standing for delivery? Who's bringing in billions and billions and billions and billions every single month? Who's doing it and where's it going and who's paying for it? Who's got enough money to buy 100 million ounces of silver in the last 40 days and take delivery of it? So, interesting times for sure, and that to me is what's most different about everything.
COMEX just crossed a line it was never built to cross. In a single month, more than 64 million ounces of silver were delivered, followed by nearly 36 million ounces in a non-delivery month, something Rick Rule says he's never seen before. This isn't retail speculation, and it's not paper rolling over contracts. These are the most well-funded, most informed players choosing physical possession at scale, 5,000 ounces per contract, and doing it repeatedly. When a market designed for speculation is suddenly forced to settle in real metal, price stops being the signal. Delivery is, and that's why this move matters far more than anyone's reporting.
Very interesting, Andy. If we look at sentiment, I think you're one of the best person to talk about sentiment in US. How are you viewing what's happening right now? Is it a big shift from what we've seen, let's say, 12 months ago, 18 months ago?
Sentiment by the public, yes, it's starting to grow. It's hard not to. I mean, you would think that after watching silver move up 150% on the year and gold about 80%, even though it gets virtually nothing in the way of media coverage. It's funny, you have more what's it called? Reuters write about it and simply say that silver had a great run, and they call it silver the devil's metal is the name of the article. It had a great run, but they call it the devil's metal. Everything that you get from the media, what little you do get, is usually cast in some sort of a shadow that speaks to either the run has passed, that it's overbought, technicals look bad, this is what happened in 2011, or this is what happened in 1980, time to lighten the load. I don't know. I think that the overall allocation to precious metals in the matrix from Joe and Jane Sixpack to the Harvard Endowment Fund is still very, very small, less than 1%. Rick Rule always says 0.5%. Maybe it's a little bit more. It's expanding, but not anywhere near where it should be based upon not only its performance, but what's happening with the dollar, the de-dollarization, what's happening with the treasury market, what's happening with the labor market, what's happening with the indebtedness. I think that people look at gold and silver as an investment, and those who look at it from the outside, I look at it as wealth. And I would far, far, far rather hold my wealth in gold and silver, which have been slowly and steadily appreciating for the past 25 years, just about outpacing everything, than holding it in dollars, which acts more like a melting ice cube in terms of its preservation qualities. So I don't know. I think that the public will wake up, but still far from, I would say, a sentiment indicator that's off the charts. It's just starting to wake up from hibernation, so to speak. So yes, getting better, but still a long ways away from where it should be, especially when you look at the action on COMEX, which, again, the most well-funded and well-informed traders on the planet, and I'll highlight well-informed. They know where things are going. People don't spend hundreds of billions of dollars just for the hell of it. They know where this is going. And who is it? Is it the U.S. government? Is it Warren Buffett? Is it Tesla? Is it Samsung? Who is it? These are the questions people should be asking themselves. But that alone should tell you the answer. At that level, they understand and they're prioritizing physical possession over anything else. And spending that kind of money tells you they're not doing it just because they want to capture a trade. They're doing it because they see it as being pivotal to where we're going.
Right. Andy, of course, nothing goes up forever. So I suppose what I would like to ask you, what would be some of the signs that you would look for to determine that maybe we're reaching this intermediate peak? So would it be these deliveries maybe beginning to decline? What would be some of these factors that you will look for?
I mean, to me, look, I think it's always wise to, especially in a market that has moved up the way that this one has, I think, it's probably wise to have some sort of caution. Silver and gold can pull back, right? I mean, after a vertical move, oftentimes you'll see what's called an air pocket or a sharp air pocket, profit taking. Margin pressure, they keep raising margins, right? Headline risk, it's gone up too fast, or it's overbought, you name it, you'll see it. A $10 to $20 correction in silver or a $100 correction in gold is not only possible, it's normal in the bull market. And it was up $6-7 yesterday. You didn't hear anyone complaining about it. But it's the underlying conditions that got us here more than anything. And I think I would make a distinction between thesis risk and price risk. And in other words, you have tight physical availability across the globe in all the major exchanges, coupled with massive delivery demand. That's the thesis. In a paper market that's been asked to settle real world demand in real metal, that it may not actually have. You look at what's happening in London, the rehypothecation is beginning to break the system. So yes, if you're asking, in other words, could gold and silver drop next week? Of course it could. And I'd actually be surprised if we didn't get some sort of a violent pullback along the way. But if you're asking, does the pullback change the bigger picture? I don't think so. In fact, to me, and I'm not saying this as a salesman, I'm saying it as in a market like this, if you think about it, a dip is a gift, because these dips will be driven by positioning and leverage, not by a sudden surplus of metal. When you have the whole world rushing to accumulate this stuff, the physical metal that has been levered on the exchanges, my simple advice is, if you're a trader, trade it. But if you're trying to protect your purchasing power, the risk isn't that silver goes from 80 to 70 or that gold goes from 4,600 to 4,500. To me, the risk is waking up in a market where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to pay is gone. So I guess the real answer is short-term caution, absolutely. Long-term conviction, 100%. And they ought to be able to both be true at the same time. In my mind, they are.
Certainly, really good points. Andy, if we look at the US stock market, so first of all, how are you viewing the health of the equity market? Of course, a lot of people believe it's extremely overvalued. Others, they would say that maybe we will sort of grow into those valuations in time. How are you viewing that? And if we do get a relatively violent pullback in equities, what would that mean for gold? Do you believe some of that wealth would flow into gold if that does occur?
Yeah, I don't know how you grow into those valuations in an economy such as ours, where the majority, by the way, of the appreciation in the indices are held up by 7 stocks. The breadth is as bad as it's ever been. And so when you talk about really a AI revolution and a tech revolution leading the way, and not to mention in the S&P 500, which again is, when you measure price to earnings ratios, when you look at the dividend yield, they're pathetically low from a historical standpoint in terms of value. But when you look at this great revolution of AI and a S&P that was up under 20% last year, well, silver was up almost 8 times that amount, and gold was up 4 times that amount. Quadrupled it in the face of the biggest tech boom ever since the internet. In terms of how would it affect the stock market, and I don't think that this is something you just grow into. Because where's the growth, by the way? When you look at our country, let's just be flat out honest about it. We have a $38 trillion debt. We have almost $200 trillion in unfunded liabilities in Medicare and Medicaid and Social Security and government military pensions off balance sheet. A trillion seconds ago was 31,688 years ago. Ray Dalio just came out and said that 60% of the United States has a reading literacy rate below that of the 6th grade. We're uneducated. Our manufacturing, what manufacturing? We don't make anything. So we're broke, we're uneducated, we don't make anything. AI's here, which is going to kneecap 40-50% of all the entry-level jobs within the next few years and take away a lot of the white-collar jobs, such as being an accountant, analyzing a balance sheet for a real estate investment trust, like my son was doing at Price Waterhouse. He works for me now, but what do they need a kid getting paid 80 grand a year to analyze a balance sheet when AI can do it in 1/10 of a second for free? But this goes on through all sorts of industries. So you look at, how do we grow our way out of this problem? We have fiscal irresponsibility, we're broke, we're uneducated, AI is coming, we don't make anything. Do you see that there is a problem here? And that's kind of been my thesis about how you bring back manufacturing for a while. But the bottom line is simply this, that the market is wickedly overvalued. There is a disconnection between Main Street and Wall Street. And I don't think that changes anytime soon. And you ask what would happen to, to the precious metals in the face of a market sell-off? Well, ask yourself this, by the way, before you even think of that. Why is Warren Buffett sitting on $400 billion in cash? Why did Bezos sell $7 billion in Amazon? Why did Zuckerberg and Jamie Dimon and why are they selling? And why are the insiders for most of the year last year selling between $1 and $3 billion a week in equities? Point of it is that the insiders are already tiptoeing out as the public is all in. Largest percentage allocation, mom and pop, retail public to the equity market ever. largest percentage of option investment ever by the retail public, and largest amount of margin debt ever by the public, about $1.5 trillion. So you got the public all in on margin, speculating through options and on margin. And so as the insiders are leaving, and at the same time you're seeing the biggest money in the world stand for delivery in metals, and no one knows who it is. What could possibly go wrong in all of this? What I will say to you is that the public will be left holding the bag, and the big money is already quietly tiptoeing. Look, the central banks have been doing this for years, and now you have the big traders here in the U.S. I think it's inevitable that we see a pullback in the equity market. And what does it do? I don't know what it does to the precious metals market. It is inversely correlated, they say. You would expect it to go much higher, but all I can say to you is that this is a time, I believe, to stand away from the equity market that has risen to tremendous heights, has done so on the back of 7 stocks, has done so as the economy underneath it does not support its growth, in my opinion. So return on money is nice, return of it's a whole hell of a lot better, but you look at gold, it's outperformed the S&P for 25 years, average 9.9% versus 9.6, just barely, but that's even with dividends reinvested the whole way. No one does that. And you look at the last several years, gold is starting to pull away from it, so is silver. And I would just simply say to you that this is not the time to be riding this late stage in an equity market that's paying nothing in the way of dividends, that is overextended, and is detached from the real economy on the back of an inverted pyramid. In other words, 7 stocks holding up the other 493. I don't know. I think it would be very bullish for gold overall.
Yes, and gold and silver recently broke out a very important trend line against S&P 500, so that's also very interesting. And so, Andy, do you pay attention to Japan and the fact that their yields are increasing, which could technically mean that some of that capital could flow away from US back into Japan?
It has no choice but to flow back in, as far as I'm concerned. Yes, the piggy bank of the world has been broken, in other words, and there is no question in my mind that as the Bank of Japan is forced to retreat from this yield curve control that they've had for a very long time to defend the yen and to prevent a complete collapse of their own bond market, you're going to see Japanese institutions, financial institutions, they'll be forced to repatriate their capital, to your point. They need to sell their foreign assets and bring the money home to buy bonds, Japanese bonds, to create a domestic bid to replace the waning influence of the Bank of Japan. The Bank of Japan is stepping away from this. That means yield curve control is gone, which means they're going to sell their bonds. Who's going to support the bond market but the financial institutions? In other words, they have a pension market with $1 trillion in U.S. treasuries that they're holding, and a lot of it, I don't know exactly how much, but pretty damn well near that. And those institutions will, in essence, sell the U.S. Treasury because it's almost underwater with the conversion rate and the higher rate and of yield, that is. They'll bring that home and they'll put it in Japanese bonds, taking the place of the Bank of Japan, is in essence their playbook. That's what they want to do. Will it happen? Yeah, I think it will. And just as bullish as the carry trade was for the world, where institutions, not just in Japan, but all around the world, could borrow, in essence, yen for zero and then convert it to dollars or convert it to euro and buy assets at a much higher yield and make free money. For a long time, that's been going on. And just as bullish as that was for the global marketplace, I would argue it would be just as bearish, if not more, because of the leverage employed, pulling it back. It's a scary thing.
Yes, definitely. So going into 2026, Andy, do you have a favorite in the precious metal sector? Will it be gold, silver, platinum, palladium, or do you sort of see them all as one big picture,
I mean, to me, I look at gold and silver as the two. I mean, platinum has got a lot of potential. It's just hard to come by in the physical world. There's not a lot of it these days, and U.S. Mint hasn't made any in a couple of years, and what is made in tiny volume by the mints and the refineries. But I think silver is the buy of a generation. I mean, the U.S. government calls it a critical mineral. The European Union did that a couple of years ago, called it a critical mineral. And now China, of course, as everyone's talking about, is implementing export controls, considering they refine 70% of the world's silver doré. But what no one is talking about is that in November, a few months earlier, they said we're going to prioritize our silver for domestic consumption. So not only are they tightening their exports, but they are also favoring domestic consumption over foreign exports. And for the potential of silver, but when the music stops, you want to be in gold. So I look at them in some ways quite equally. Silver is going to give you greater, a greater return. Gold is going to, I think, ultimately shock people how high it goes, but I don't think you'll get the leverage that you get with silver right now. So I guess for me, it's 50-50. I like them both, and I wouldn't be surprised to see both of them go higher this year than just about every analyst on the planet thinks they will go.
Right. Okay, so I'll ask you this question, Andy.
But can I just say one other thing?
Yeah.
I don't tell people to buy this stuff to get rich. You don't buy it to get wealthy. It is wealth. It's wealth that has outlived everything the world has ever thrown at it. And here we are, 6,000 years after together they were mentioned 700 plus times in the Bible, and the biggest, most well-informed money on the planet. Central banks, commercial banks, sovereign wealth funds, whoever the hell is standing delivery for hundreds of billions of dollars on COMEX, whoever the hell is draining the LBMA. These people do not do this for the hell of it. They know where it is going and what it means to have gold and silver at a time like this, when one is being considered critical and the other is being rewoven into the monetary system. So you don't buy it to become wealthy. You own enough of it, you will. You buy it because it is wealth. Sorry about that.
What Andy is pointing out isn't a price story. It's a structure change. A market built to roll paper contracts is now being asked to deliver real metal month after month at volumes that were never considered normal. When the most informed players stop trading and start taking possession, it tells you something fundamental has shifted. Prices will move, pullbacks will happen, but delivery behavior doesn't lie. That's the signal most people are missing. And now that you understand why this matters, you're going to want to see what comes next. Because in the next video, we break down the second order effects this delivery surge is already triggering across silver, gold, and the broader financial system.